Thanks for tuning in again this month for our educational video. Today, the fellows and I will be talking about short-term market volatility versus long-term financial success. Recently, we've had a war in Iran. We've had tariff concerns between Canada and the United States. And all of these headlines oftentimes cause short-term market volatility. In fact, in recent months, or certainly in the last couple of years, many of you may have noticed, depending on the size of your portfolio, um, you know, volatility. You might see your portfolio go up many thousands of dollars, or depending on your size of your portfolio, a few percentage points down might mean being down 100 grand in a month or a quarter. All this is entirely normal, and we're here to reassure you that short-term market volatility, while uncomfortable, does not mean that it's necessarily a detriment to your long-term financial success. I'll pass you over to Kevin and Alex, who will dive a little bit deeper into this topic.
Thanks, David. When we look at investing for retirement or any other sort of long-term goal, generally we're looking at a time period of 10 years, 20 years, 30 years, or potentially even longer than that. And during that time, the market's going to have bad days. It might have bad weeks, bad months, or even a bad year. But your financial plan isn't based on what the market is doing day to day to day. Your financial plan is based on what is happening over the entire period that you're invested. A way that I like to think about this is, let's say you're planning a multi-year long road trip. Let's say you're going to be on the road for 10 or 20 years. If you had a pothole as you're leaving your street within that first 5 minutes of the drive, is that really going to deter you from continuing on to the rest of your road trip that you've been planning so long? Probably not. And investing is the same way. There are going to be hiccups, potholes, roadblocks along the way. But what it really comes down to is your plan, your financial plan, and staying invested throughout so that you can reach your goals.
Over short periods of time, markets can be driven by elections, geopolitical events, interest rates, inflation, or even just investor sentiment. And they can cause a lot of day to day, week to week, even month to month swings in the market. But when we broaden that view and take a look at long term market growth, that is driven much more by corporate earnings, innovation, economic growth, to name a few. And that's why trying to predict what times to get in and out of the market to get around these short-term volatilities can be extremely difficult, but also very counterproductive to reaching your long-term goals. One of the biggest risks to clients and their portfolios isn't market volatility itself, it's how we react to that volatility.
Yeah, exactly. And when we're seeing the markets fall, it can be really tempting to, leave the markets and go into a safer investment like just holding cash for the time being. However, the problem with that is that the markets, they don't send us a notification. You don't get a text on your phone saying, all right, the worst is over. It's now time to reinvest. What often ends up happening is that the turnaround from the very worst to the strong recovery is very, very quick. It can turn in a day or in a couple of days. And if you're selling during the downturn to avoid some potential losses, oftentimes what's going to end up happening is you're going to miss some of the best parts of that recovery or all of the recovery. This is why here at Perler Financial, we always stress staying invested rather than trying to time the market.
Now, this doesn't mean that we simply just ignore short-term market conditions. In fact, your portfolios are being reviewed constantly by us and by the portfolio managers who run them. Now, short-term volatility won't mean that your investment strategy is broken and needs to be changed. That is more dictated by your life goals or financial goals changing. Maybe your risk tolerance has changed. Items like that are what would cause us to kind of reevaluate the investment strategy, not some day-to-day fluctuations in the market. In fact, volatility itself is really the price that we pay for the potential of gaining long-term market financial growth within the portfolio.
So the next time you see the markets are having a difficult time, maybe a difficult day, a difficult week, or a difficult month, try to stop yourself and zoom out on the situation a little bit. Ask yourself, has anything changed about my long-term financial goals? Rather than asking yourself, well, what's happening in the markets and the headlines today? When you start asking yourself that question, the answer often becomes, no, nothing's changed, and my investment strategy shouldn't change either. Just because there's a lot of noise out there doesn't mean that I shouldn't be sticking to the plan that I made for myself.
So just remember that investing isn't about predicting what the markets will do tomorrow. It's about setting yourself up with the best chance to reach your long term financial goals in the most cost effective way possible. And to use Alex's analogy from earlier, it's about building the plan and not worrying about the potholes you may encounter along the way. But if you have any questions about your portfolio, updating your plan, please feel free to give Harry, David, Alex, or myself a call anytime.